But we are starting with the July jobs report. As I mentioned, we got that jobs report this morning at 8:30. It's a very important indicator of the health of the U.S. economy. The labor force in July added 164,000 non-farm payrolls. That is just about in line with expectations, which were for 165,000. Now, the unemployment rate stayed exactly the same at 3.7%. That was compared to expectations of 3.6%. So, what to make of this report? And can we get excited about it? Maybe not. Joining us to discuss, Marci McGregor. She is an investment strategist at Bank of America Merrill Lynch. Hey, Marci.
Thanks so much for having me.
Thanks for coming on. What do you make of the report? I see the headlines are in line with expectations, although we were in the newsroom and I was kind of saying, well, if you really want to kind of pick at it, both numbers are lower than what the expectation was, but fine, in line.
And then there was a revision to the last month, but very much in line with expectations. And I think the real takeaway is it's in excess of what we need to keep up with population growth, which is good news. And it's moderated a bit. We're seeing the pace of job creation moderating a bit. But that, to me, tells us that we are on a sustainable growth path. The U.S. is continuing to grow above trend.
So what do you make of the uptick in wage growth, now at 3.2% year over year?
So it was a really modest uptick. It's been bouncing around in that neighborhood for some time. So I don't think it's enough to cause any sort of inflation concern. You know, inflation really peaked last summer and has been on a downtrend. And that's one of the reasons we got the Fed cut this week.
Right. Yeah, you know, when you look at the report, I saw a tweet that I thought summarized it well that basically said that right now the U.S. economy is like the port in the storm. And obviously that's the story behind the Fed cuts as well, as we have all this global uncertainty, but the U.S. humming along.
Yeah, one of our themes is that it's the U.S. versus the rest of the world. And the U.S. is growing above trend. And we're seeing growth slowing at the edges globally, but still probably just below trend. So it's kind of U.S. pulling ahead of its peers.
So speaking actually about that global uncertainty, obviously we had President Donald Trump talking about tariffs on that extra $300 billion of goods. Now, I saw that in this report, the retail numbers essentially under pressure, on decline. Do you actually imagine that those tariffs actually might continue to impact those numbers going forward in the upcoming jobs reports?
Yeah, so this re-escalation in the trade tension is something we're going to watch closely, and that's because the consumer has been the driver of the U.S. economy. We're seeing it at earnings. The consumer economy is strong. So there's a couple ways this could go. The consumer could balk at higher tariffs if they go into effect, and that would be deflationary, or it could impact consumer confidence. Consumer confidence has been pretty high since the beginning of 2017, and actually has stayed in a pretty tight band. They are the engine of growth. I think of the U.S. economy as a two-track economy. The first one dominated by the consumer and small businesses. Small business optimism is strong too. The second track tells me more about the global economy than the U.S. economy, and that's manufacturing, which has been declining, and now we're seeing manufacturing data creeping towards 50, and it's large business optimism. So CEOs are telling us the weight of the trade war is weighing on them. That could impact hiring. We haven't seen it yet, but so far, no impact on the trade war on the U.S. consumer. We even look at regions where it's heavy agriculture. We're not seeing a dip in spending.
Yeah, we've been waiting a long time to see when it would actually hit the average person's wallets, and there's been so much talk about it, and it just still hasn't happened. But I think a lot of people are anticipating that maybe come holiday season, that is when you might finally see a real actual backlash to the tariffs.
Yeah, I'm going to keep watching the consumer closely. I would say in terms of data, I'm going to watch the consumer confidence and small business optimism the closest.
Wait, Marci, just quickly, what are your thoughts about the September FOMC meeting? We just got a rate cut, not necessarily because the U.S. economy is weak, but more because there's so much uncertainty. So what's your prediction for September?
Yeah, so our view is that you get a 25 basis point cut in September and October.
Really?
Wow.
Two more
So a
this
total
year.
of 75 basis point cut. Okay.
Yeah, things aren't bad enough for two more cuts, are they?
But I don't think that's the key. The words that screamed at me from Powell was mid-cycle adjustment.
Oh, okay.
It's not about slowing growth.
Right.
It is about policy risk, tariffs. It is about inflation that has dipped lower. And I think it's about extending this expansion. So we're looking at it as a mid-cycle adjustment. For all the talk of late cycle, Powell said mid-cycle, and that tells me something.
Wow, two more cuts.
Wow.
You heard it here.
I know,
Bold. We're going to keep you tuned. We'll have you back on. Marci
Excellent.
McGregor, thanks so much.
Thanks for having me.